Hello everyone and welcome to Mango Monkey Learns Money. In my channel, I want to give you guys ideas on how to become a millionaire, and I truly believe that this can be done if you can invest $100 each week and have the patience to wait up to 55 years. You only need to be able to achieve a 4% annual rate of return, which is very easy to do, and you do not need to learn too much about investing. If you want to get there faster, you can either invest more or somehow get lucky or get smart to achieve a higher rate of return. So in this video, I'm going to look at investing into large companies like your Microsoft or Google, or if you're in Australia, your Commonwealth Bank and BHP, versus investing into small companies. Like in Australia, these are your Webjet online travel booking service, your Zipco, your NEXTDC, Myer, Mesoblast, and many more. I'm going to start the comparison by looking at Australian shares because I am in Australia. In Australia, there is what's called the S&P ASX Small Ordinaries Index. The ticker code for this is XSO. This is Australia's top 300 companies minus Australia's top 100 companies. So in other words, it is the smallest 200 companies within the top 300 companies list. Did I just confuse you? I got confused myself too. Anyway, the market cap of these small companies is anywhere between 100 million Australian dollars and 10 billion with a B, Australian dollars. The average market cap is around 1 billion Australian dollars. So these companies are actually fairly large companies. They are not your startup type of companies. I'm going to compare the ASX Small Ordinaries Index with the ASX Top 100 Companies Index, and the ASX code for this is XTO. If I look at the data over the last 1 year, as of 28 October 2020, they are pretty much the same. But the small companies outperformed a little bit. If I look at the 10-year historical performance, I can see that the bigger companies outperformed. Now let's switch to the United States. The top 500 companies over there has an index with ticker code SPX, and that's the black line on the screen. There's also the bottom 600 companies within the top 1,500 companies, and the index for that is known as the S&P 600 with ticker code SML, and that's the blue line on the screen. Over the last 1 year, it seems that the large companies performed better. That's also the case over the last 10 years. But that's since this year, probably because the large tech stocks like Facebook and Amazon have been going up like crazy. If we go back to 2018, it seems that the small companies performed better. So is there any conclusion that can be drawn from these charts? I think it is very hard to say, and I would love to hear your comments. But I suspect that some small companies can grow faster compared to the big companies. But because we are looking at an index, it essentially includes all the small companies regardless of whether they have growth potential or not. The index also includes struggling small companies. So that's probably why the small company index doesn't do well. You could choose the small companies yourself, but this is difficult, and even Warren Buffett mentioned that the majority of fund managers cannot beat the average market return. If you choose the wrong stock and the company goes bankrupt, you may lose a large proportion of your wealth and you will need to start over from the beginning. Choosing strong companies is even more important in 2020 with the coronavirus pandemic creating uncertainties in our economic recovery. The largest companies with strong balance sheets are more likely to have the financial resources to weather the storm. So I think for the majority of investors, investing in an index ETF tracking large companies is the better way to go. It's just a little bit safer, and the investment return seems to be about the same anyway. Unless of course you get lucky or you are a genius which means you are probably not a human being. In other words, you do have to get lucky. Sometimes I do wonder why I bother making investing videos on YouTube. It seems to me that everything is really random. I cannot beat the market performance. And if that's the case, I might as well put all my money into an index ETF tracking the largest companies and not bother trying to improve my investing skills. Anyway, I would love to hear your thoughts. Do you have a preference towards large companies or small companies? Or if you're in Australia and you want to get a free $10 or $20 from a small neobank, please check out my video on 86-400. The link is in the description. You don't need to invest anything. This is not a scam. It's not a scam at all. It's completely safe and it will get you $10 or $20 depending on when you sign up. Sometimes they give you $20, other times they give you only $10. Have a lovely day, everyone.